Hello, I'm Chris Pedersen and this is Stock Watch for Wednesday, the 24th of January, 2024. All advice is general advice and might not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. A few market observations. The ASX 200 is a little over 7,500. I would personally not be too surprised if we see it rise close to 8,000 this year. That's because rates are stable to maybe down a little bit. However, the bank bill futures contracts are showing that there's not going to be much of an expectation of a rate drop going out 12 months. Keep an eye on that because that will give you a good clue as to what the probability of rate drops will be. Iron ore is still strong even after a small drop last week. WTI, which stands for West Texas Intermediate Crude Oil, is at $74.48. This is up $2 from last week. However, it is still pretty low considering where it's been for the past few years. We all have heard that OPEC cut production, trying to raise prices. However, the reason it really hasn't had much impact is because the United States continues strong production and growth in production. This is a fascinating chart on China population growth rate. The bottom line, green, is their death rate. The other line happens to be their birth rate, the amount of population that's growing, not dying. As you can see, they're having more deaths than growth. The Magnificent Seven. This is a term that you will become familiar with over the next year or maybe next decade. These are 7 companies, tech companies in the U.S., and look how they've performed versus the S&P 500 and how they've performed versus the S&P 500, excluding the Magnificent Seven. Here they are. These valuations are in trillions of dollars. The market cap for Microsoft is $2.9 trillion. It is up 79% since October 2022, and these numbers are through the 19th of January 2024. Apple Computer, $2.9 trillion in market cap also, and that was up 49% in that period. Alphabet, $1.8 trillion, up 39%. Amazon is worth $1.6 trillion, and that was up 38%. Rounding up the rest of the 7 is Nvidia, worth $1.4 trillion. This is the outstanding performer. That has been up 419%. We don't get companies like that in our market very often. Meta is worth $1 trillion, and that was up 198%. And rounding out the 7 is Tesla, which is only worth $0.7 trillion. That was actually down around 7%. So Tesla's got a few problems, but we'll see if they can fix it. Collectively, these companies were up 117%. 3 companies caught my eye I wanted to share with you. The first one is Lynas Rare Earths. I've been watching this company ever since inception for them. The code on the ASX is LYC. Right now it's trading around $5.92. Looking at the chart, you'll see that it peaked and it's been declining since then. What are my views on its prospects? Well, let's take a look at the numbers. These are UBS estimates. Market cap for this company is $5.9 billion. The 12-month price target UBS has is $9.20. That's up significantly from where it is now. Revenue growth rate for 2023 to 26 is estimated at 27% per annum. And the earnings growth in this period is 11% per annum. Now, on a dividend growth basis, right now they don't pay any dividend. And it won't start paying a dividend until around 2015, and the estimate is around 11 cents. The PE on Lynas's 2025 earnings per share estimate of 38.5 cents is only 15 times. The yield on the 2025 dividend estimate of 11 cents is 1.9%. The free cash flow is small at 1.5%. Obviously, it doesn't have a payout ratio because there's no dividends. It's a big disappointment to the market, as the chart shows, but my sense is the worst is behind it. The hype and excess value that was put into Lynas is now gone. It is decent value. But because of this downward decline, I'd only buy a half weight, But watch, if it starts to rally in terms of the fundamentals and the market recognizing it, then I'd increase to a full weight. Next company is NextDC. The code on the ASX is NXT. It's trading around $13.57. So this company's been up at this price before and it tailed off, but now it's back up there. So on a technical basis, this is like, will it have a breakout or is this a resistance level? The numbers on a fundamental basis can help us on this. These are UBS estimates also. It has around a market cap of $7 billion, and they have a 12-month price target of $17.20. That's significant from where it's trading, and it's up from $15.40 the last time they had a price target. So they are becoming very bullish on this company. Revenue growth from 2023 to 2026 is estimated 14% per annum. So this is what's attractive, is this revenue growth rate. However, their earnings right now is negative 2 cents. And in 2025, it's estimated to be negative 16 cents. And dividend growth rate, they don't pay any dividend. And if you're not earning a profit, obviously PE is a meaningless ratio. And there's no yield on no dividend. Free cash flow around 2025 is estimated to be negative 9%. And obviously no payout ratio. So what does NextDC do? They develop and operate data centers around Australia, and they also coordinate networks. I do not personally like companies not making a profit. It has good growth, but if they can't turn that into profit, well, it's not a good investment. You are investing for dividends and profits. Absent that, it's not worth putting money into. However, because of this revenue growth rate, if they get their expenses under control, meaning they then become more profitable, it's worth watching and maybe jumping in at that point. I'm going to put it on my watch list, and if I see this improve in terms of profitability, I will let you know. The last company is IDP Education. Code is IEL. It's currently trading at $19.92. And looking at the chart, it's been in decline since it rallied after COVID. These are UBS estimates also. The market cap is $6 billion, so this is a substantive company. 12-month price target is $27.60. It was $30.45. Now this leads me to a very important point about investing, that when analysts are raising estimates, that's positive. Even if it's a neutral, if they're raising estimates, watch that company, because those are companies you want to buy into. Analysts becoming more bullish. Now, if a company is a buy recommendation and analysts are starting to lower the price targets, well, now that's a worry. It still might be a buy, but why buy when analysts are not as strongly positive as they were before? It's a conundrum. Revenue growth rate for IDP Education for the 2023-2026 period is estimated around 10% per annum. And the earnings per share growth during this time is 15% with dividend growth of 14%. The PE on 2025 earnings estimate of 67 cents is 29 times. That's large. The yield on the 2025 dividend estimate of 50 cents is 2.5. Free cash flow is 3% and the payout ratio is 74%. So what does this company do? They're an international education group for immigration purposes, which means English language, prepping people to get jobs, things like that. They operate in Australia and many overseas markets. So this is a big company. As the world grows in population and as immigration between countries grows, this company is a beneficiary. The UBS price target is 33 times for the 2026 earnings estimate. This is too high. My view is the price has to decline to get a better PE before worth investing. While this company has all the good numbers in terms of growth, it's still expensive. So again, this is wait, watch it, and if the price drops, that's when you want to buy it. As always, if you want to learn more about anything I covered today, send an email to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. Have a wonderful week, and I hope it's profitable. Thank you for your time.